I'm Zanny, Minton, Beddoes. Thank you, Daniel. And welcome to this first session on the economy. I was hoping to start with the more optimistic part of the world, which is the emerging economies. But unfortunately, one of our speakers is caught in traffic. So we're going to start right here at home in the US. And the US, I would submit, is the biggest single uncertainty hanging over the world economy right now.
No.
So the US. Are we going to fall off the fiscal cliff or not? And if we do fall off the fiscal cliff, what will the impact be on the US and the world economy? I suspect that is the single most important question hanging over the world economy. And we have I really couldn't think of a better person to offer a prediction on that than Peter Orszag. Peter Orszag is known, I think, to many of you, but he's vice chairman of global banking now at Citigroup. He has been and was at the beginning of President Obama's first administration, head of the Office of Management and Budget, and before that, head of the Congressional Budget Office. Without further ado, Peter, what is going to happen in 2013?
Thank you.
Do you want to be serious at all, or do you want to come
I'm going to
here?
break protocol and go join Zanny while I do this.
Well, I hope your mic grip works better.
It does.
Okay.
4 predictions for 2013. To start with the optimistic one, I think the unemployment rate will end the year below 7% as the housing market continues to recover. The benefits from low energy prices, energy costs continue to feed into a bit of a resurgence in U.S. manufacturing, and as the lingering uncertainty surrounding the fiscal cliff fades. Second prediction is that Medicare costs will grow at less than 3% nominal, which is unbelievably low by historical standards and is lower than the 3% that was achieved or that we saw last year, in the continuation of an increasing movement towards a value-based healthcare system and a dramatic deceleration in healthcare costs, which over time offers the best opportunity to make up the hole in workers' take-home pay that has arisen over the past 2 to 3 decades because of globalization and technological change. Third prediction is a little bit more dire with regard to healthcare, which is that life expectancy for the bottom 30% of the population will decline. This is part of a longer-term trend in which there have been increasing gaps in life expectancy, going up very rapidly at the top of the education and income distribution, going up much more slowly or declining at the bottom. That's combined with a very odd feature that as economies slow down, life expectancy tends to improve, and as economy picks up, life expectancy tends to not rise as rapidly in aggregate, which is an odd finding, but one that's found in a whole variety of studies. So as the US economy continues to pick up, that will unfortunately mean that the underlying trend in life expectancy for the bottom 30% will, again, not be so great. Final prediction. The top marginal tax rate in the United States will rise to at least 37% for at least one taxpayer. And the long-term fiscal gap that the nation faces will remain above 5% of GDP. It's currently hovering something around 7% of GDP. I think the big risk at this point on that prediction, by the way, and perhaps we'll get to this during the discussion, is I think the administration has a lot of leverage to obtain some marginal tax rate increases, and in some sense, the concern of the fiscal cliff at this point is overblown. The concern should be shifting to the debt limit, because it's entirely possible that the administration will win on the fiscal cliff and then face a debt limit problem in February.
That's actually where I was going to start.
10 seconds left.
Very, very good. That's where I was going to start, and I know you've made 4 predictions, and I'm going to ask you for a 5th, which is tell us what happens in the next 2 months. How does, at the beginning of 2013, do we technically go over the cliff, or is there actually some agreement before the end of this month?
Well, look, I think there will be an agreement. I don't know whether it'll be January 10th or December 28th, but there will be an agreement over the tax rates. And the reason is that on that point, unlike entitlements, which I'll come to in a second, the Republicans have put themselves in a box that is not tenable. To argue that on principle there shall be no increase in marginal tax rates for anyone opens up the possibility for a Machiavellian Democrat, Chuck Schumer comes to mind, to come along and say, okay, here's my proposal. We're going to raise marginal tax rate from 35% to 35.5 above $10 million in income. Are you really going to blow up the deal over that? If you do, I think you're committing political suicide. If you don't have a principle anymore. And so the fact that fact combined with the fact that a lot of outside pressure is now being brought to bear on that question, I think means that the Republicans will ultimately cave on that question. The problem, however, is the administration is now really jamming them not only on that, but also on a clean debt limit increase. They have to just vote for a debt limit increase without entitlement reform being attached to it, and that may be overstepping. So one possibility here is the Republicans cave on the marginal tax rates. There is a fiscal cliff deal, but they're not willing to raise the debt limit at the same time.
And what about another part of it, which I'm sure is of huge interest to a lot of people in this state? What happens to deductions? Are there deductions, limitations, or not?
I think it's very likely that there will be some tax expenditure process. So if you have a marginal tax rate increase that's less than to 39.6%, there will be some limit on itemized deductions or some process that will fill in the details on how to limit itemized deductions, details TBD over the next 9 to 12 months. But yes, I think what basically will happen is they're going to be aiming for, roughly speaking, $1 trillion in revenue. They're not going to be able to fill that hole through the marginal tax rate increases because they're going to be smaller than what the administration has proposed in that bucket, and they'll fill in the difference by cutting back on tax expenditures. So it'll be a little bit of mix and match.
I'm going to open the floor to questions in just a second, but one more, which is your prediction of the unemployment rate being below 7%. Had we had this conversation a week ago, I would have said it was even more optimistic.
I made the prediction before Friday, right?
You did,
yeah, okay.
And you didn't adjust it, which is interesting. But so the economy presumably is doing reasonably well. I mean, do we end 2013 with the view that the U.S. is, the best performing of the advanced economies, the big advanced economies?
The U.S. has, I think, a pretty good medium-term growth prospect, both because of the energy boom, because of increasing efficiencies in healthcare, and because of still being the world leader in technology, which is a big advantage. On the other hand, the one other point that I think needs more emphasis is if you look out over the next 10 to 20 years, the underlying potential growth rate of the U.S. economy is slowing because of demographics, because average educational attainment is no longer increasing, and because we're going to have the drag from the aftermath of the financial crisis for a long period of time. So the next year or two or three looks better than what we've been experiencing, but you have to realize better means 3% growth, not 5%.
On that note, are there any questions? I'm going to put my glasses on now. You can see, that's good. I can't. No questions? Because I have loads more if there are no questions, but I don't want to miss out yours. Gentleman right here at the front. That's a very good question. Can we continue to print money without causing inflation?
I think one of the most challenging lines that the next chairman of the Federal Reserve will have to walk is between unwinding the balance sheet expansion that has occurred while avoiding putting too much negative pressure on the economy by doing so while we still have an elevated unemployment rate. So you can get that balance wrong, and waiting much too long could unleash inflationary pressures. My own view is that that's a much smaller risk than the risk that we wind up with very slow growth for a very long period of time and a very elevated unemployment rate. And the reason that I think it is a risk but not the dominant one is that while the economy remains weak, which I think it, relatively speaking, will for a prolonged period of time, it is very hard to spark inflationary pressures. First. The second thing is the U.S. doesn't have high unionization rates. It doesn't have a lot of indexation built into the system. So even if you had an initial spark of inflation, it's much harder for it to take hold. It's not impossible, and a lot comes down to the credibility of the Federal Reserve in saying we won't allow that to happen. That credibility could be endangered if they wait too long. So a risk, but not the one that I think is the dominant one.
Something to worry about, not in 2013.
Not at 20. The probability.
So we'll have to come back next year and the year after, and we'll tell you when to worry. Another question. Yes, gentleman right there, 5 rows back. Maybe you should wait for the microphone. It's just coming.
The record decks.
Do you see areas like untapped productivity or underused productivity in the economy?
Well, I guess there are a couple ways of answering that. The first is we still have massive untapped productivity because we're not using all the plant, equipment, and workers that we could. The unemployment rate is still elevated. There are millions of American workers who could go back to work if there were demand for what they could produce. And so that's the biggest hit to productivity, not only today, but also out over time, because if they don't get back to work now, they may never come back to work as their work skills atrophy, and that's a huge problem. The second thing is if you look at where we are inefficient, the reason I'm glad that there's a panel on healthcare, and the reason one of the predictions focused on that is by far the biggest area in which productivity improvements are both possible and beneficial. Estimates suggest that we spend $750 billion a year in healthcare services that don't improve health outcomes. That's $750 billion that could raise take-home pay, that could go into other investments, that could be more productive, and we need to be tackling that problem as aggressively as we can. Recent evidence on that is starting to look moderately encouraging, but we're, on mile 2 of a marathon there.
Can I just actually put I guess it's your second and third, or second and fourth prediction together, which is reasonably upbeat on medical cost control. 3% nominal growth of medical costs, that's much lower than it has been historically. On the other hand, you said that the overall fiscal gap would still be 5% of GDP relative to 7%, which basically means we haven't solved the fiscal problem.
And the way to reconcile them is I should have said as estimated by the Congressional Budget Office.
I.e. is not my prediction?
Yeah, well, no, because CBO is not going to take into account the slowdown in healthcare costs for a very long period of time.
Okay, but it's a bigger picture point, which is the improvement in the slowing of healthcare costs enough to, with the whatever tax and entitlement deal you expect next year, for us to be able to say at the end of 2013, we've pretty much fixed the US's medium-term fiscal plan?
Not really, for 2 reasons. The first is that the deceleration in healthcare costs is still in its infancy, and it's too soon to conclude that it will persist. The second thing is the revenue base that both sides are locking into. Let's say we raise the marginal tax rate to 37% and we cut back on some itemized deductions. That revenue base for 2020 doesn't work. The revenue base is too small. And by the way, this is why both sides are agreeing to caps on discretionary spending without identifying any of the underlying detail that allow you to hit that cap, because they want to hit a deficit target. The revenue base is inadequate to hit that target, and so they rely on basically a gimmick to get there, which is we promise we'll cut spending by a certain amount, but we're not going to tell you how.
That sounds very Washington. We've got time for one more question. Any more questions? Yes, gentleman up there.
I have a question about, you said that there are factors lagging economic recovery. I'm wondering about student debt and how the burden of student debt is going to play into the economic recovery in 2013.
Very good question.
Well, it's part of a broader question, which is we're most but not all the way through the deleveraging process following the financial crisis. That has been a significant hindrance to economic growth as private sector debt skyrocketed and has only slowly been coming down. If you look at aggregates, though, if you look at household and nonprofit debt as a share of disposable income, it is now most of the way back to pre-crisis levels, which is a very big positive. Now, with regard to student debt specifically, obviously that is a particular area of stress. And I would just come back again and say one of the reasons why we are seeing very dramatic increases in tuition at public universities, which is where most students go, is that state appropriations at the state government level for those institutions of higher education have been curtailed. That in turn ties back to rising healthcare costs through Medicaid. So we're looking at the symptom here, which is these unsustainable debt levels for many students, but the underlying cause here is tension at the state government level, which no longer sustains the low tuition levels that were the case 20 or 30 years ago.
I see that we have 12 seconds to stop, and I'm going to get into terrible trouble if we go over it. So we're going to have to stop there, but I think we can conclude by saying it was, what would you say, basically pretty, glass half full or half empty on your part?
Oh, half full.
More than half full?
Much better than it's been, relative to the last 3 years, 90% full.
Great. Terrific point to conclude. Thank you so much, Peter. Thank you.